Today I want to tell you about two business owners that I worked with. Different industries, different cities, but they both came to me having used the same funding tool. One of them used it to grow, the other nearly lost everything. The tool was a merchant cash advance, and the difference between what happened to each of them had nothing to do with the advance itself. It had everything to do with how they used it. MCAs have a bad reputation in some corners of the economy. And honestly, some of that reputation is deserved. Not because the product is inherently bad, but because it gets sold badly and used recklessly. But I've watched MCAs save businesses or double businesses' revenue as well. Fund equipment purchases, keep trucks on the road during slow seasons, buy inventory that's tripled a business's revenue. So in this video, I'm gonna give you the real story on merchant cash advances. What they are, how they actually work, when they make sense, when they don't, and how to know which situation you're in and whether an MCA is the right fit for this particular situation. This is the unfiltered version with no fear-mongering, just the truth. What an MCA actually is. Let's start with the basics because there is a lot of confusion around what a merchant cash advance actually is. Technically, an MCA is not a loan. It is a purchase of your future receivables at a discount today. A lender gives you a lump sum of cash, and in exchange, you agree to repay a larger amount over time, either through a fixed percentage of your daily or weekly revenue, or through a fixed daily or weekly payment. The contract language that gives it away is purchase of future receivables. If you see that phrase in the agreement, you are looking at some form of a merchant cash advance, regardless of what the broker calls it. And here is where most brokers are going to get creative with language. You might hear these referred to as working capital loans, short-term business loans, revenue-based financing, short-term funding, fast business funding, bridge financing. Same product, softer packaging. I'm not saying those terms are always dishonest. Revenue-based financing, for example, can describe a legitimate product, but you need to look at the actual contract structure to understand what it is that you're getting into. Most people just use the term revenue-based financing to package up their MCA and make it sound fancier. How factor rates work. Here's the most important thing to understand about MCA pricing. Factor rates, not interest rates. An interest rate is calculated on the remaining balance of what you owe, and the amount of interest that you're paying on that loan usually decreases over time as you pay down the principal. A factor rate is different. It is a flat multiplier applied to your original advance, and it does not decrease as you make payments. You are taking out X and paying back Y. So if you borrow $50,000 at a factor rate of 1.35, you're repaying $67,500 total. That means your cost of capital is $17,500 on top of the $50,000 in principal. And usually you can save a considerable amount in fees if you pay within the first 90 days. A lot of cash advance lenders have prepayment incentives so that you can actually reap benefits of a lower cost if you pay early. Factor rates typically range from a 1.15 or 1.15 on the low end. That's a lender who sees you as very low risk, to a 1.59 or 1.59 on the high end. For every $10,000 that you borrow at a 1.15, you're paying back $11,500. And at a 1.59, you're paying back $15,900. And they can range anywhere in between. And then, like I was saying before, MCAs offer early prepayment incentives. If you pay off the balance within a certain window, 30, 60, 90, 120, or 150 days, some lenders will forgive a portion of the remaining fees. Not all of them are going to advertise and tell you about the prepayment incentives though. So it's worth asking about when you're reviewing any funding agreement. Repayment structures. There are a few different ways that MCAs are repaid, and the structure matters for your cash flow. The most common is a fixed daily or weekly ACH debit from your business checking account. The lender sets the amount when the advance is originated, and it comes out every business day, Monday through Friday, no weekends or holidays, or every week until the balance is paid off in full. The original model, which some lenders still use, is a percentage of your daily credit card sales, meaning that your payment is going to be variable and fluctuate with your revenue every single month, every single week. On a slow day, you pay less. On a good day, you repay more. The fixed daily ACH and the percentage of sales model, or credit card split as they call it, each have their own advantages depending on your business. Neither is inherently better than the other for cash flow. It really comes down to your revenue structure and which repayment pattern works best for how your business collects money. And for stronger borrowers with a track record of repayment, some funders offer bi-weekly or monthly payment schedules. These are harder to qualify for in the MCA world, but if you can get it, it gives you a little bit more breathing room. Or if you can't get it, it's probably because you can't handle a large monthly or bi-weekly payment, because they're looking at your average daily balances in the bank's checking account. And sometimes if those are low, a monthly payment on a short-term credit facility can be detrimental. Client story number one. Here's the right way. Here's one of the clients I mentioned at the top. He's a trucking owner-operator, a solo driver, one truck, consistent revenue, but cash flow timing issues that almost every owner-operator faces were burdening him. He had a huge contract that he won. He picked up the load and delivered, but the invoices went to the client, and then that particular client waits 30 to 60 days to actually pay the guy. Meanwhile, fuel, insurance, and maintenance bills were not waiting. He came to us needing a quick bridge, and this particular client did not qualify for factoring. And he didn't have 2 years of business tax returns yet, which took traditional bank loans off the table. We placed him in a single MCA, structured the payments properly, and payments aligned with his deposit cycle, with a factor rate in the low 30s, 1.32, I think. He used the advance to cover fuel and insurance for 6 weeks while he waited on payment from the new client with the big contract. When those payments hit, he paid off the advance early, triggered a partial fee discount through the prepayment incentives that came on the MCA contract that we got him, and came out having paid a 1.15 factor rate, or 15% for the cost of his capital. The MCA kept his truck rolling during a timing gap that otherwise would have forced him to turn down this big contract. That is an MCA used correctly. Clear purpose, clear return on investment or ROI, and a clear path to repay it. Client story number two, the guy that got trapped. Now here is this other story. Another client was in the construction business with strong revenue and multiple contracts in the pipeline. He came to us and we set him up with capital, and things were going well. Then, without telling us, he went out and started to look for more capital. He took on 3 additional advances from other brokers. Within 60 days, his bank account was being debited by 4 separate lenders every single business day. We had gotten him a weekly payment and a long term, but these other brokers, they were not able to do that because he was getting so much money within a short period of time. So the funders that he got after we got him funded were high-risk funders that only did daily payments. So his daily payments alone at the end of this 60 days were consuming more than 40% of his daily deposits. He started bouncing payments. The funders filed UCCs against his assets and his receivables. His business credit took a catastrophic hit, as well as his credibility in the lending world. He ended up in a debt settlement program with a company that didn't even settle with the funder correctly. And lenders will not touch him to this day because of that history that he has. His business was actually generating good revenue. We had a solid plan for him to get to profitability. The problem wasn't the business. It was the fact that he went out and thought that he needed more and more and more capital, and just throwing money at his problems would make them go away. What should have been one strategic tool became a debt spiral for this guy because he stacked too many MCAs. When I say MCAs have a bad reputation in some corners, this is why. Not because the product itself is toxic, but because when it is misused, or when a broker stacks multiple advances on top of each other without disclosing the cumulative payment impact that it's going to have on the business owner, the damage can be severe and lasting. And that's why I would be very careful when a broker says that it's okay to take more than one advance, especially the ones that get you capital and then call you a month later asking you if you need an add-on. An add-on is basically another way to say, hey, let me stack this shorter term, higher risk and higher priced MCA behind the one that I just got you. So be wary and tread safely. Let's talk about reverse consolidations. I want to teach you guys about the reverse consolidation program because it may be the lifeline that you need if you've already found yourself up to your head in MCAs. Here's how it works. A new lender is going to come in and put money in your bank account every single week, specifically to cover your existing daily or weekly MCA payments on your behalf. And then you will pay that lender that came in to cover your weekly liabilities a lower payment at the end of the week, or multiple smaller daily payments, so that you're saving anywhere from 20 to 40% on your payments every single week. Once your original advances are fully paid off through that process, you're left with that single consolidated obligation at a more manageable payment structure. It doesn't erase the debt, it actually adds more debt. I want to be clear about that. The total amount you owe does not disappear. It reorganizes it in a way that gives your cash flow room to breathe, stops the bleeding on your bank account to some extent, and positions you to eventually transition into a term loan or an SBA product once those advances fall off. We use reverse consolidations sometimes at Small Biz Heroes to bridge clients that got stacked by other brokers and they find themselves in a situation where they need a way out. It's not a permanent fix, as you still need a longer term plan, but it can be the reset button. If you find yourself stacked with 3 or more MCAs, that keeps the business alive while you build towards better financing when an MCA makes sense. Let me be direct about when an MCA is a smart move. You have a time-sensitive opportunity with a clear positive return on investment. A big order, a seasonal buy, a contract that you need working capital to fulfill on, and the opportunity is worth more than the cost of the advance. Your revenue is strong, but traditional financing is not accessible yet, whether that be due to lack of credit or collateral. You're under 2 years' time in business, maybe something like that. Your credit has some issues or your documentation isn't complete for a conventional loan. You have a clear path to graduate to better financing, meaning that the MCA is a bridge to something cheaper, not a permanent state. You are taking one advance, 2 tops, not multiple. You understand the payment impact on your daily cash flow and your average daily balance can support it comfortably. If you can check those boxes, an MCA can be a legitimate strategic tool. If the purpose is vague, the math doesn't clearly favor you, or you're already stretched, you don't want to put a band-aid on a bullet wound. You want to use this quick to access, convenient capital on an opportunity that is going to generate more revenue than the cost of the capital. It's a simple equation. In my book, The Hero's Journey to Capital, I have a full chapter dedicated to alternative financing, including a complete breakdown of MCAs, factor rates, reverse consolidation, and how to evaluate whether any of these tools actually fit your specific situation. If you want to go deeper on this, the book is in the description. There's still a lot more about merchant cash advance that I just don't have the time to include in this video. So if you're trying to figure out whether an MCA makes sense for your business right now, or if you're already in one or multiple and not sure how to navigate it, please talk to us. This is what we specialize in. At Small Biz Heroes, we look at your full picture. We have private lenders that will buy out your MCA balances and extend the term. If an MCA is the right tool, we'll find you one with great terms. If it's not, we'll tell you that too and get you into the next best thing or a better program. The link is in the description for a free walkthrough of what makes sense for you and your business right now. I put out new videos every week as well, so make sure that you're subscribed, and I'll see you in the next video.